Hi, everyone. Welcome to A View from the Floor here at the New York Stock Exchange. I'm always delighted when I'm joined by Tim Anderson, Managing Director at TJM Investments. Always great to see you. And Tim, there's been a lot of volatility since the beginning of the year, obviously, since Trump took over for presidency. However, with all that being said, the indices have relatively been flat. Can you tell me a little bit about how investors can navigate the market through the rest of the year?
Well, I think the most important thing is to carry on with your investment strategy absent the whole tariff drama. Because what we saw was a very sharp decline when the initial tariff announcements came out in early April. And then most investors were surprised how easily we staged a V-shaped recovery in the market and most major indices, to the point where now we're actually, as you said, close to where we were. We're not quite at the all-time highs that we had in right in the middle of February, but we're within range of those, 2 or 3% maybe from all-time highs. And I just think there are clearly issues in the tariff front that need to be resolved for the market to have a good second half. But I think for right now, investors need to just kind of let that go in their thinking, because everything, I think, when a push comes to shove, will get worked out. The only example might be that the toughest part of it will be what we do with China.
What are some of the key factors right now that's creating market movement?
Well, clearly investors have been on sharp down days. A lot of those in the last few weeks have been sparked by rates going higher, sometimes quite a bit higher, over maybe just like a day and a half or 2 days. And I think investors react to rates moving sharply over a 2 to 3 day period more so than exactly what level they're at. I think it's almost a little bit ironic that you've got the 2-year right around 4%. You've got the 10-year at about 4.5%. You've got the 30-year hovering at about 5%. Now, I remember when an upward sloping yield curve like that was a sign of a very strong economy. And what most strategists and investors were worried about was a flattish or inverted yield curve. Now people are worried about rates going higher. Look, we had from today's perspective, or from the perspective of the last 15, 20 years, we had very, very high rates in the second half of the 90s, with long rates in the 5 to 5.5% range. And the market and the economy did extremely well because the economy was growing faster than the rate of inflation, and at a rate at least equal to longer rates. Now, I think part of the problem is you've got a tremendous amount of people managing an incredible amount of money in their mid to late 30s that for 10 to 15 years were conditioned that the world revolves around zero interest rates. So that, I think, just dominated their train of thought to a large extent. And they need to make an adjustment, not the market.
Are there any current events out there or economic data that is really trending for trading activity?
Well, plenty of them. I mean, the inflation reports are going to be very, very important because really inflation has been extremely benign. I don't want to say there's no inflation, but the last key data point we had showed year over year at 2.2, 2.3. I think the Fed's target is 2. So, I mean, we're basically there. And I think the Fed has held back cutting rates a little bit because they don't know what the impact of the tariffs are going to be. And they won't know until 6 or 8 months after they're imposed, because you won't see the data flow through. You won't see the tariffs flow through to the hard data for at least 6 months. But I think when the Fed becomes convinced that they can lower rates without sparking inflation, that they will. And there's probably 2 or 3 rate cuts between now and the end of the year. But clearly, we also have tariff issues that are still outstanding. We hear that there are 2 or 3 deals in the inbox, so to speak, that need to be, looked over and finalized and okayed and signed. We'd like to specifically see that happen just to give the market some clarity and also to kind of set the bar as to what the outstanding negotiations might look like. But then there's also a lot of geopolitical concerns. We 3 months ago, 4 months ago, at the beginning of the, we thought that we were on the verge of peace on numerous fronts around the globe, and most of those situations have gotten hotter, not cooler. I mean, clearly the Russia-Ukraine conflict is raging. Iran is belligerently looking to do nothing in terms of negotiation with us on their nuclear front, and the Israel-Gaza situation is probably better than it was a year ago, but still, unresolved. So that's, look, the market's doing an incredible job of climbing this proverbial wall of worry in the face of those issues.
There's still a lot going on out there, obviously. Finally, what sectors do you think are showing a lot of strength or showing weakness today?
Well, look, the steel sector was showing a lot of weakness until you had this culmination of this Nippon Steel, U.S. Steel deal after the administration got confident that the Nippon Steel would not disrupt the current operations of U.S. Steel or move. You're not really going to move a steel plant to Japan, obviously, but they were going to basically invest, tens of billions of dollars in the business here, and that will create some economic growth and some jobs. And now the steel industry is in addition to the tariffs, whether they're going to be 50% or not going forward, we're not sure. But if you're going to have tremendous infrastructure and industrial investment in the U.S., both from domestic entities and all of these foreign entities, a lot of which was announced in this trip to Saudi Arabia, to me, you're going to end up using a lot of steel in one form or another. Okay, so that industry was way behind. It got a nice 10% bounce earlier in the week. We have to see if that sticks, and maybe we get some guidance on some pricing power in the steel industry going forward. But, other than that, the AI stocks were under pressure for the better part of 6 to 8 months. They've seemed to come around now to, looking much healthier both on the charts and in some of their guidance from their latest earnings calls. And the other thing that's really actually helped the market quite a bit is that the dollar has been very weak. And I know, look, the Fed doesn't overview, it's really the Secretary of the Treasury's domain. They're always going to say that we promote a strong dollar policy. That's just the way it is. But yesterday, earlier in the week, the dollar made its second lowest level in the last 3 years. That's actually good for the stock market because stocks are priced in dollars, both here and around the globe. So it's cheaper to buy them. And in fact, last night you had major ETFs in the UK, in the Eurozone, and in Japan make 52-week highs. So that is the direction of the U.S. dollar is something to keep a close watch on.
Tim Anderson, thank you so much for your time, as always. And that'll do it for me as well. I'm Michelle Yu here at the New York Stock Exchange. We'll see you next time.